How's real estate? Well, let's get right into this week's update. I wanted to chat with you for a second about what's really been happening in this housing market lately, especially with all the noise coming out of Washington. The recent government shutdown was more than just a headline, it created real stressful problems for everyday buyers and sellers right here on the ground. The National Association of Realtors, which I'm a member of, recently reached out to agents nationwide to get a first-hand report on the situation. The response was huge. Hundreds of realtors from every state sent in personal stories about what they were seeing. What we heard confirmed our biggest worries. This shutdown causes serious delays and uncertainty that can make or break a deal. The biggest issue we saw was with essential government-backed programs, things like VA loans for our military families, FHA loans, and crucial USDA loans for properties in rural areas. We're all getting hung up. We had a huge number of stories that specifically mentioned holdups with these federal agencies, and that's not even counting the headaches with the IRS or even basic flood insurance renewals. Think about a family in a coastal area or a service member using a VA loan. Their deal might have been ready to close, but suddenly the necessary final approval from a federal office is stuck in a limbo. We saw deals collapse because the National Flood Insurance Program, or the NFIP, couldn't process a simple renewal. This meant families were losing the homes they were excited to buy, and it created a painful domino effect that hits sellers, lenders, and even local small businesses that depend on that closing money. One agent put it perfectly. For many transactions, especially in places where federal assistance is common, the shutdown turned the closing process into a train wreck. Military families who already sacrificed so much were left struggling with delayed loans and added financial pressure. When the market feels this volatile and uncertain, it makes people nervous. Sellers pull back, the pool shrinks, and suddenly that essential foundation of the American dream, homeownership, starts to get chipped away. Ultimately, we're all urging Congress to put the politics aside. We need stability back in the economy and, frankly, back in the housing market so we can help people like you successfully buy and sell homes without these completely avoidable obstacles. That certainty is what our clients deserve. Now let's talk about mortgage rates for a second, because we talk about this every week, because we just saw a slight shift that's good to understand. For the last month, about 4 straight weeks, rates were actually dropping, which was a nice little break. In fact, they recently hit their lowest point in more than a year. But this past week, that trend reversed just a bit. The average rate for a standard 30-year fixed mortgage moved up slightly, climbing from 6.17% to 6.22%. Now, that's not a huge jump, but it's the first time they've ticked up in 5 weeks. We also saw a similar small increase for 15-year fixed mortgages, which are popular for people refinancing, going from 5.41% to 5.5%. It's important to keep some perspective, though. Even with this slight rise, today's 30-year rate is still quite a bit lower than they were a year ago, when it was sitting closer to 6.79%. So what causes these little movements? Basically, mortgage rates are tied to a few big picture things. They are definitely influenced by the Federal Reserve decisions on interest rates, but they also follow what's happening with the bond market. The main idea is that when people who invest in bonds start feeling more optimistic about inflation and the overall economy, it affects the bond market, and that movement usually pulls mortgage rates along with it. The main takeaway is that lower rates are always good news for everyone involved in buying a house, because they instantly give home buyers more purchasing power and make it more financially appealing for current homeowners looking to refinance. It's always smart to keep an eye on these numbers. Now I wanted to share some great news about why Florida keeps topping the list for retirees. If you've been considering making a move for your golden years, this will give you the inside scoop on why everyone is talking about the Sunshine State. Wallet Hub recently put out their 2025 report on the best states for retirement. And once again, Florida held firm at the number one spot. It's a combination of two things that really drives our ranking: great quality of life and genuine affordability. When you're planning a retirement, the weather is fantastic, but the real secret weapon for Florida is the financial advantage. This is the part that gets most people excited. We're incredibly tax friendly. When you move here, you are saying goodbye to state income tax, inheritance tax, and estate tax. That means more of your retirement money stays right in your pocket. In fact, there is even talk right now about potentially getting rid of property taxes for seniors, which would make the financial picture even sweeter down the road. This focus on financial well-being, paired with the state having a really solid infrastructure built up over the years for residents, is what makes it so appealing. Beyond the money, the lifestyle is unmatched. It's hard to beat year-round sunshine, easy access to our miles of coastline, and all the recreational opportunities that come with it. The statistics back this up, too. Florida has the third highest percentage of residents aged 65 and older in the entire nation. It's a place that's been attracting seniors for decades, and that long-standing appeal proves it's an ideal blend of practicality and comfort for making the absolute most of your retirement. As a real estate agent, I often get asked when the absolute best time to buy houses. And the end of the year, right around now, is actually one of the market's best kept secrets for buyers. You usually think of spring as the prime time, but the next few months present some seriously good opportunities to land a great deal before things get heat up next year. One of the biggest factors right now is the money side of things. We've seen mortgage rates come down a bit, hitting their lowest point in a while. Lower rates mean your monthly payments are more affordable, which is a huge deal when you're thinking long term. On top of that, there is generally higher in inventory, meaning more homes to choose from. When you have more options, you have more power to negotiate, and prices tend to be more stable before they potentially climb back up when the spring buying rush starts. Beyond the rates and the inventory, you also run into what we call motivated sellers. Think about it. If a home is still in the market in November or December, the seller likely wants to close the deal before the new year. This is especially true for home builders who often offer fantastic end-of-year incentives like covering some of your closing costs, buying down your interest rate, or throwing in great upgrades. If you can close before December 31st, you also might be able to take advantage of tax deductions for mortgage interest and property taxes for the current year, which is a nice bonus. It's really about taking action while conditions are in your favor. If you wait until the spring, prices could rise, the competition will certainly increase, and there's talk that lenders might start scrutinizing loan applications more closely in the new year. By jumping in now, you lock in more affordable financing, you build equity sooner, and you avoid the stress of bidding wars that often pop up once the weather warms up. It's a smart, strategic move for anyone looking to buy. Congratulations again on getting your keys. That is such a huge step, and I know you're probably still figuring out where to put all your furniture. But now that you own the place, there are four really essential things you need to know right away to keep your home safe and save yourself from some major headaches down the road. Think of this as your quick start guide to successful homeownership. First, you need to be able to find all your utility shut-off valves and fast. If a pipe bursts or you smell gas, the clock's ticking. You need to know exactly where to turn off your water, gas, and electricity. For the water, the main valve is often in the basement, a crawl space, or maybe under a panel outside. If you're not sure, call a plumber or have them show you. For the electricity, that's usually the biggest switch at the top of your main breaker panel. If you have a gas leak, the most important thing is to get everyone out of the house immediately and then call the gas company from a safe distance before you try touching the meter outside. Knowing where these things are is all about buying yourself time in an emergency. The second crucial item is fire extinguishers. Every home should have at least one, and I honestly recommend one for every floor. Keep one right near the kitchen, since that's where most house fires start. It's not enough just to buy one, though. You have to make sure every person living there knows exactly where it is and how to use it. Also, check the pressure gauge, even now and then. If that little needle is sitting in the red zone, the extinguisher won't work. So you'll need to replace it or have it professionally recharged. Next, let's talk about warranties and the age of your home major components. You need to gather up all the paperwork from the previous owners and see which appliance or structural warranties transferred to you. Sometimes things like roofing materials have a warranty that lasts for decades. Knowing what's covered can save you thousands of dollars down the line. While you're doing that, jot down the age of things like your water heater, HVAC system, and the roof. When you know how old these big items are, you can start planning and saving for their eventual replacement. So you aren't hit with a massive surprise bill when they finally quit. Finally. And this is a big one. You have to budget for the inevitable emergencies. I know you just went through closing, but you need to start setting aside money specifically for maintenance and repairs. We see it all the time. A recent survey showed that over 40% of new homeowners spend more than they expected on repairs. A good rule of thumb is to try and save about 1% of your home's purchase price every single year. So, if your home costs $400,000, aim to set aside $4,000 for upkeep, repairs, and those surprise moments. Having that dedicated fund will turn a major emergency into just an inconvenience. Now let's talk about something I see every day in the market, and it's a tough reality, especially for people who are just trying to buy their first home. National Association of Realtors just released a big report, and the main takeaway is pretty jarring. The percentage of people buying a house for the first time has dropped to a record low, only making up about 21% of all purchases. Here's a ticker that really shows how much things have shifted. The typical age of a first-time home buyer is now 40 years old. That's a huge change. For decades, homeownership was something people achieved in their late 20s or early 30s. Reaching this milestone later in life isn't just a number. It means people are missing out on years of building equity. That's the wealth you build up as you pay your mortgage down and your home value increases. Experts estimate that delaying homeownership until 40 instead of 30 can actually cost a person around $150,000 in lost wealth on a typical starter home. So, why is this happening? It's really a tale of two markets. On one side, you have experienced homeowners who are moving up or downsizing. They already have equity from their previous sale, which means they can make big down payments. The median for them is about 23%. And a lot of them are even paying all cash. On the other side, you have the first-time buyers, and they are struggling against a major lack of affordable homes for sale. They're getting creative to scrape together the median 10% down payment, often relying on personal savings, tapping into financial assets like a 401k, or getting gifts and loans from family and friends. Another interesting factor is that current homeowners are staying in their houses longer than ever, a median of 11 years now. When people don't move, fewer homes come onto the market, which tightens up the supply even more. That scarcity drives prices up and makes the home market less accessible for someone trying to get their foot in the door. Ultimately, solving this problem requires addressing the root cause. We need more homes built, especially at entry-level price points, to balance out the competition. Even in this challenging market, though, having a good agent is key. As 88% of all buyers used one, we're the ones helping you navigate these hurdles and find those scarce opportunities. Now let's chat about home equity. Sounds like a simple idea, but honestly, it's one of the biggest parts of owning a home that people misunderstand. And getting it wrong can cost you a lot of money. Think of your equity as the piece of your house that you actually own, free and clear. The first mistake people make is thinking that their home's value is the same as their equity. That's not true. That's just not true. To find your true equity, you have to take your home's total value and subtract whatever you still owe on your mortgage. If your house is valued at $500,000, but you still owe $200,000, your equity is the $300,000 left over. That distinction matters a lot, especially if you ever plan to borrow against that value. Another common myth is that your equity will just keep growing forever, no matter what. After the last few years, where prices shot up like crazy, it's easy to assume that's how things always go. But real estate markets change. If you bought a home back before the crash around 2008, you know that home values can drop. And if they drop enough, your equity can actually disappear entirely, leaving you owing more than the house it's worth. Equity growth isn't guaranteed. It depends on the market. Now, while we often think of equity as something that takes decades to build up by paying your mortgage every month, that's not the only way to do it. You can build equity much faster right from the start by making a bigger down payment when you buy the house. You can also make extra payments toward the principal part of your loan or make smart renovations. Things like upgrading your kitchen or bathroom tend to add real value, which boosts your equity faster than just waiting for the market to move. One of the most confusing areas for people is when they want to borrow against their equity. You'll hear terms like home equity loan or HELOC, home equity line of credit, and most folks think they're the same thing, but they're different. A home equity loan is a one-time thing. You get a lump sum of money and you pay it back over time at a fixed interest rate. A HELOC, which stands for home equity line of credit, is more like a credit card. You're approved for a maximum amount and you can borrow what you need, only paying interest on the money you actually use. Plus, HELOC rates are usually variable, so your payment can change over time. You need to know which one you're getting. Speaking of borrowing, just because the interest rates for these products are typically lower than a credit card, don't assume they are always cheap. In today's economy, rates for home equity borrowing are often much higher than they were years ago. Your rate will depend on your credit score and the lender. So it's essential to shop around and remember that cheaper isn't the same as cheap. And this is a big one. Taking out a HELOC or home equity loan does not impact your primary mortgage. These are considered a second mortgage, meaning they are completely separate debts. Your original mortgage rate and terms stay exactly the same. The confusion probably comes from another option, the cash out refinance, which does replace your original mortgage entirely with a brand new, bigger loan. You also have to understand the risk. Some people mistakenly believe that as long as they keep paying their primary mortgage, their house is safe, even if they miss payments on their HELOC or home equity loan. That's a dangerous mistake. Since the HELOC is secured by your house, the lender has every right to start a foreclosure process if you stop paying them, even if you're current on your main mortgage. Both lenders have a legal claim to your property. Finally, just because you have a huge equity number on paper doesn't mean you can access all of it. Lenders have rules, and they usually only let you borrow up to about 80 or 85% of your home's total value. This is a safety net that protects both you and the bank if the housing market dips. They want you to keep a piece of your equity stake untouched. While you might find a handful of lenders who let you borrow more, they usually charge you a significantly higher rate for that extra risk. So while the big equity number is exciting, it's not all cash you can grab. Understanding these key differences from what equity actually is to how the different loan types work is the most important financial lesson you can learn as a homeowner. If you're ever thinking of accessing that value, always talk to a professional to make sure you're doing it safely and smartly. And that's how the market's shaping up this week. My goal is always to give you clear, straightforward information you need to make sense of the real estate world. If you're looking to buy, sell, or just stay informed, be sure to like and subscribe for these updates every single week. Thanks for watching, and I'll see you in the next one.